5 minutes, 4 minutes really. Three minutes, then we'll get going, 8:15. 90 seconds, apparently. 90 seconds. You guys hot to go? HOTTOGO? Who's alive? Turn me up! Turn me up! I gotta move. Give me the juice. I think we should just get going. I can't take it any longer. All right, let's go. All right. How you doing, Forex.Today? Hey, we're a YouTube channel of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal. Did I lose the volume? No. The overriding goal of planning our trades in advance because trading is risky. Not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I salute you. So what do you want to do today? Gold, oil, Bitcoin, dollar pairs, yen pairs? You want to talk technicals, fundamentals? What do you want to do? Well, we can do all of it. Yeah, so what do you need to succeed in the world of FX? Well, you need a good execution trading partner. Absolutely. And so what you want is an ECN. An ECN, what they do is you place a trade. It goes into a pool of liquidity partners, which is by definition the interbanking system. All other brokers, they just put you into a pool of their other idiot traders. You trade against each other. If there's too much of one side, then the broker takes the other side and trades against you. And they never execute your trades into the interbanking system. They just laugh at you when you lose because it's in their best interest for their clients to lose money. Well, I don't like that. That rubs me the wrong way. So you need an ECN. My ECN is Trader's Way. Okay. There are others out there. There are a few others. There's not many ECNs because, I don't know, well, it's an ethical business model, and I guess the other brokers don't like that. So anyways, there are a few other ECNs out there. Do your due diligence, do your research, but start with Trader's Way because, well, maybe because I recommended them. Also, we're going to use traders.com. Yeah. Traders.com. We're going to use it today, and it automates your technicals and your fundamentals. It does market sentiment research. We have live performance coaching 3 or 4 hours a day, some more, actually 4 or 5 hours a day. And we also have courses in community. Okay, courses. Well, how many courses? I don't know. 18, 19? Are they short little 5-minute videos? No, they're usually an hour to an hour and a half long lectures. There's a lot of crap out in the world. This stuff is good. University quality courses. Sure, some are better than others. Some are newer and older. But there's a lot of information. About 100 hours. Whoa. So let's get into the fundamentals. Okay, so if you sign up for traders.com, guess what? It's $300 a month. Oh my God, Wayne, that's so expensive. Wayne, that's so expensive. Well, let me show you something. And we covered this today. And we tried to cover it yesterday, but internet was pretty bad, or whatever it was. This page in of itself, okay, about 20-something years ago, I used Commitment and a Trader's Report. And guess what? I needed something like this page. This is why we have it. What I used to do was cftc.gov. And then I go to the Commitment and Traders Report, and you go to Financial Long Form, and this is what you do. Canadian dollar, dealers, asset managers, hedge funds, other reportables, retail. And you would look at the change in longs. Let's say you wanted to do hedge funds. The change in longs, the change in shorts. Okay, and then you do your calculations from that and the total change. And you do that for Canadian dollars. So that would take, I don't know, 20 minutes. And then you do that for Swiss franc, another 20 minutes. Pound, British pound, go to leverage, go to open interest, go to the change in long, change in short, total changes, week over week. And then, and you do that for the yen and another 20 minutes for, everything like Aussie dollar and Mexican peso. Okay, so you would do this. It would take hours and hours and hours and hours. It was a lot of work. And you did it from your Excel spreadsheet. So 20-something years ago, a service came out that, well, it didn't quite do this, and it definitely didn't do that, but it did this. Okay, this is analyzing the number of contracts long and short. So the number of bulls versus bears for euro and the number of bulls versus bears for dollar. So asset one is green, so that's euro. And you could see the market not only, right, has a little less contracts, but it's a little more bearish. This is green. So it's below zero, which means the market is net short euro. And then over here in red, which is the second asset, so dollar, okay, there's a rise in the number of contracts by hedge fund managers. Not only are they long the dollar, they're slightly more long. And not only are hedge funds slightly, or are net short euro, they're slightly more net short euro. This right here, my friend, just that, let me go through here. Just this, because I had it for every asset class. Okay. That cost me $300 a month. Just that. Then it was $300 a month for my charts. And then it was $300 a month for this. And $300. It costs thousands and thousands and thousands of dollars to run a small, intelligent, but small trading business. Now, all of it is $300 a month, which is ridiculous. Ridiculous. Redonkulous. It's so cheap to run your Forex business now. It's cray-cray. What's going on, Silly Sally? Yeah, how do you, so Silly Sally says he's going through a tough period of performance. What I like to do is I like to focus on building rebuilding confidence. So what I would do is lots of smaller little basic little trades. I call it putting, and just make 20 or 30 or 40, maybe 100 smaller trades, easy stuff that you can knock down and just rebuild confidence. Don't make it about money. Just make it about setting up really good trades and just pulling some pips. It kind of looks like scalping, but what I would do is I would set longer term charts. So let's say I only trade, I do all my analysis on the 4 hour, but then let's say you make a bunch of easy trades on a 5 minute and just pull 10 pips out at a time or something, and just build some confidence there while you wait for market conditions to be more favorable to your strategy. Okay. Now, yeah, Richard is talking about this stuff here. Yeah, this is actual positioning by hedge funds. So yes, you're actually seeing our buyers buying, our sellers selling. So for example, we can get this in the capital flow. So this is the positioning right now. Institutions are long gold, they're short the CAD, there's no doubt. Okay, but that's a capital stock. This is the capital flow, what happened week over week, not the total, but what's happened week over week. And you might say, well, okay, so everyone went long Rand and everybody went short oil. Is that true? Not necessarily, no. But the market did go up or down in positioning. So sometimes you'll see like something dramatic here with Bitcoin. 17,000 less contracts long and 26,000 more contracts short. So much less bullish and significantly more bearish. Wait, am I looking at treasuries instead? Sorry, treasuries. Okay, so there was something quite significant there. But you also want to look at the percentage change. Okay, percentage change. How many bulls left? How many bears left? And that really impacts things. I'll give you another example. The British pound is about 50-50 as far as long-term positioning. But week over week, bears, some bears, okay, 6% of bears became bulls. Bears became bulls. Even though the market's 50-50, bears became bulls. Guess what? Pound went up. Okay? And you can find situations, and I think we did find, I don't know if I can go through and burn through some of this to get but things like gold, okay? 12,000, almost 13,000 less bulls, which is a 3.6%, okay? Week over week change in bullishness. Less bullish. But the market's 85% bullish. It's just there was almost a 4% change in bullishness to the downside. Now, hardly anyone's short gold, but in this case, there was an increase, a 10% increase in bears. Now, the total amount is still very, very, very bullish, but 4% less bears. Man, I'm screwing this up over and over again. Sorry. Almost 4% less bulls and 10% more bears. Okay? Yeah. So, what is this part? 12,700 contracts took profit. How do I know it's profit taking? Well, everybody's long except a couple of knuckleheads. You see? Okay. Hang on. All right. The bot was blocked. Got to block the bot. So anyway, so look, it's bullish. Bulls took profit. This is them getting out. What do you think they're going to want to do this week? Buy the dip. So they got out at 3,000 and they might get back in at 2,900. Second bot blocked. Okay, so you see, that could be an opportunity. So and this is real money. It's not like we're discussing how people feel. No, that's money. That's money in the market. Okay. If you can block the bots for me, guys, I can't do both at the same time. This nonsense about this stupid scalping strategy go ahead and block them. Come on, mods. All right. Oops. Clicked the wrong button. See, I'm distracted. So that's one thing. I just wanted to check. I wasn't sure if this page was working properly, and I think we can confirm. Just want to confirm. Okay, so New Zealand is coming up tomorrow. Okay, and they're expected to cut the most. And so we have a big cut coming, maybe. Okay, so this is updated. Let me double check this. Let's get that set properly. Did that update? Fourth quarter 25. Okay, it has updated. Okay, good. So interest rate forecast for New Zealand. Can you block these guys? Come on. Let's go. Block them. Block them, block them, block them. All right. Interest rates in New Zealand, we have plotted dropping to 3.75. Okay. And in a couple of months, they'll get down to 3.5 and hold till the end of the year, and then they'll cut one more time. Okay, so we have it all plotted. Here's the future path of interest rates in New Zealand. Okay, 425, 375, 3.5, 3.5, 3.25. There's the future. So they are based on what we have learned from the Reserve Bank of New Zealand, is that they will cut the most. Meanwhile, Japan is raising interest rates. So Kiwi yen, interesting, right? So we have already plotted this out. You should already know all this information. It's nothing new. Okay, that we expect 1.25 most likely. I'll change this to 3 digits maybe. 1.25. Well, that one's 3 digits. Okay. 1.2. Okay. Percent cut at the RBNZ over the next year. This is what we have plotted. So this could be, for example, the thing you are most bearish on. You wake up in the morning and it's 1:45. What do? You sell the Kiwi. You sell the Kiwi. Okay. Well, it could be, Don, but, think of it as, the government, or in this case, the central bank, is actually doing something to make Australia more competitive. So maybe it's hope. Okay. Could be hope. So I think some of these are not updating depending on our API here. Fourth quarter, first quarter. So we have them plotted dropping to 3.85. What by the end of the quarter? What is the interest rate now? Let me just double check. Reserve Bank of Australia. So they dropped it to 4.1, but that's what we've had for a while. 4.1. I don't think I can change this. I have to figure this out. I guess I can just delete this. It doesn't even do anything. All right. Let go. There we go. So we had them at 4.1 at the end of the year. We have them maintaining 4.1 in the first quarter. So, but see, it's like we're a little late, or they're a little late. And then we have them in the next few months, maybe the next meeting, dropping to 3.85. We have to change this to Aussie to have it plotted differently. So in Australia, okay, we had them at 4.1 at the end of the year. And now we and maintain 4.1 in January, February, March. So they're a bit late on the cut. Then April, May, June, we have another cut from 4.1 to 3.85. We maintain that over July, August, September, and then another cut, a big cut, by the end of the year. Okay, interesting. Now this gets tricky too. They have inflation coming down and then spiking at the end of the year. But why would they be cutting? I guess what they're saying is they think it can be so low they can allow it to go back up to 2.5. And maybe the cut here drops the value of the Aussie, makes them more competitive, increases productivity in the economy, in particular with foreign countries, which is balance of trade. And that pumps up inflation, but at a tolerable rate. Maybe they're okay with that. Yeah, we have inflation at the fourth quarter pegged at 2.4, but they expect it by the end of, so Emerald, at the end of this period, which is by the end of March, the RBA, the Reserve Bank of Australia, their own predictions, or is that inflation will drop to 2, and then by the end of the first half of the year, the RBA's predictions, their projections, indicate inflation drops by 1.5 or to 1.8. So therefore, in the last part of the year, they can go game on, increase inflation by cutting the value of the Australian dollar. You see? And based on terms of trade, they're okay with that. So a weaker dollar makes iron ore and coal cheaper for China to buy, and that'll be good for business. So Australia will win, but within that increase in demand and the new flow of capital, it'll increase inflation. Now, there was a time when Aussie was paying like 7% interest rates and New Zealand was paying 8 3/4. So maybe they're like, well, we'll get back to that 2026, 2027 are going to be epic years and we'll have higher inflation and higher rates, but we want to make sure we get there. So this is like their slingshot. I might be reading into it too much, but we have these tools and they're available for you to contemplate. So we have 2 cuts by the Fed this year. Is that going to happen? Okay. So 5.5 at the end of the year. Sorry, 4.5 at the end of the year. 4.5. So somewhere in the second quarter. Now, what I've been calling for is June and December. So June and December. So this is where June and December comes from. Is that correct? Well, this is the Fed's projections. And they change every 16 weeks. We will get an update in a few weeks from now. But this is the Fed's, the work of the Federal Reserve staff and the summary of economic projections. So, have things changed? Where do we answer that question? Fed Watch tool. And we jump there. And we go to the June meeting, June, and we see what's the likelihood of a cut. 50-50. 50-50. But actually leaning toward no cut. The probability of no change in June is 51%. Ha ha ha! Wee. And if this goes up and up and up and up, the dollar gets stronger. Now, I've taught you this 10,000 times over the last 20 years, so you should know this. Okay, so we're currently at 425 to 450. That's where we are today. In June, today, the odds are 51% that it stays. Therefore, no cut. Okay, yesterday was slightly more in favor of a cut, but I'd still say neutral, 51 versus 49.6. Okay, how about this? 1 month ago, we were quite certain 66% chance there would be a cut in June. We've gone from 66 to 50. 2/3 to 1/2. More likely, no cut in June, dollar strength. And somebody said when they looked at the Commitment of Traders report, they're like, oh, isn't that interesting? Dollar is strong. Uh-huh. And you can see it here by the trading, right, of the Fed funds futures contracts. Now, how do they know? Well, you look at the price, the average price or the mid price or the mean price of these Fed funds futures contracts. Okay? Price determines yield. So, if you lend me $95.75 today, on June 18th, I'll pay you $100. Is that fair? Well, you have to do time value of money calculations, discounted cash flows, and one of your variables will be what is the expected interest rate by the Fed in June. Some will think the Fed will cut. Some think the Fed won't cut. And you, depending on your opinion of what the future interest rate will be by the Fed, you would negotiate a contract. Higher price or lower price, depending on what you think. In this case, these are all bankers. This is Bank of America lending JP Morgan money, or JP Morgan lending Goldman Sachs. Goldman Sachs lending Wells Fargo money. Okay, this kind of stuff. Okay, this is sort of just a normal market, right? But everyone might have different opinions on whether the Fed will cut before June, on June, or later in June, right? And you will settle on a price that's agreeable to the two bankers. When you calculate the average of all these prices in which these contracts are negotiated, 51 on average, they're set for a 51% no cut. No cut in March, no cut in May, no cut in June. You see, you go to March, 97.5% chance the Fed's not going to cut. May 7th, 83.4% chance of no cut. June, okay, there might be a cut. July, see, the numbers are different. They're changing because people think cuts are coming. Others don't believe cuts are coming. So you can go all the way to December. And right now, what's priced in is 1, maybe 2 cuts. 16.4% of smart money believe the Fed can't cut interest rates at all this year. Now, how will we be able to figure out if they're right? Because remember, these are contracts actually negotiated already. The average price here is 96.0375. Okay? Lend me $96.04 and I'll pay you back $100 in a year, or December 10th. So you reverse calculate what the interest rate is and bada bing, bada boom. You see? It's cool, right? Now, what would you need to see? Like, what if these guys are correct? And by the way, I should point out, this stuff down here shows you what has changed since yesterday, since last week, since last month. And that's the shift. If this is shifting to the right, you buy dollar. If this is shifting to the left, you sell dollar. Risk off, risk on. That's how you want to use this stuff. Okay? So this is shifted towards dollar strength recently. Now you have to keep watching. Is that going to continue? Well, nobody knows. These are contracts being negotiated. So when CPI comes out, when PCE comes out, when GDP comes out, these numbers are likely to change quite a bit because it'll change people's opinions. So you can go back and say, well, looking at the United States, what the Fed expects is inflation by, let's say, the end of June should be at 2.8, somewhere between 2.8 and 2.5. What if it's still 2.8 or higher? What if it's 2.9? What if it's 3.0 as we get closer and closer to June? What do you think is going to happen? Because this is projections into the future by the Fed staff. So if we expect, let's say, this to be 2.8, or they expect it to be 2.8. Oops, come on, where's my drawing tool? Is it not drawing? Interesting. There you go. So if it comes out a little higher, and what about here? What if it comes out significantly higher? What if it's still around 2.8, 2.9, 3.0? Then, as we recognize the Fed's projections are incorrect, you then go to the CME and you track this going from 51. Oh, come on. Let me get this out of here and delete. Okay, then you track this going from 51 to 58 to 65. Okay, and as this is happening, these are shrinking, right? Right? And this would go to 0. And this would fall from 42 to 38 to 30 to 25. And this is rising. So that's a shift to the right. And what does a shift to the right mean? If all these contracts are going here, pushing the value, the number up, what do you do with a shift to the right? You buy dollar. See, think of it this way. If that's confusing, let's think of it this way. Let me get another color. I guess I'll do it in black. All right. This area here represents the Fed cutting interest rates. And if they did cut interest rates, the rate would be 3.75 to 4.0. We're currently at 4.25 to 5. So that's one cut and two cuts. Priced in. This is what priced in means. Even a knucklehead, I just noticed this, very small portion thinks we'll be at 3.5. That's what used to be the number, by the way. Okay, now remember when the Fed funds rate was not the Fed funds rate. Remember when the 10-year T-note dropped from 5.0 to 3.6? You can see there's a relationship. Well, now we're going the other way and yields are higher. But notice that the assumption here is interest rates are at 3.75. So that's what is priced in for this market. So if that goes away, right? Then what becomes the new interest rate? 4.0. Which is a hike. What happens to the value of the currency? If 3.75 was priced in, but now 4.0 is priced in, when you get a hike, in theory, It's not necessarily this way, but I'm going to, especially with the reserve currency, but I'm trying to keep it just simple. Dollar gets strong. But it's not a hike, it's a not cut. But it had to do with the pricing model of the market. So now they have to price out a cut. And then if inflation is sticky over the next couple of months, this is going to drop. So those contracts are going to go, these contracts go here, and these contracts go here. So this goes up, which represents interest rates going back to 4.25, which is a second hike based on what is priced in, not based on what the Fed is doing, what the Fed is expected to do. We're all, if you're not 3 and 6 months ahead in your analysis, then you're way behind. This has nothing to do with what the Fed's going to do next. We already have that priced in. Here's the, right? In fact, let me show you. What do you mean priced in? We've priced in March, we've priced in May, we've priced in June, we've priced in July, we've priced in September, we've priced in October, and we've priced in December Fed decisions. So this is what professionals do, and they give you a percentage here and a percentage here and a percentage here. And what is it? Why do we say priced in? Because this is the price. Prices change as expectations change, and it's the change in expectations that you, as a foreign exchange trader, should be trading. And only an amateur would say, well, interest rates are X, therefore I will go long or short. No. Vastly oversimplified. Where do you think it's going to be in 3 months and in 6 months? That's what institutional traders are trading. Right? Yeah. Now, sometimes you have to take this to another level. Behavioral finance. It's your best friend. Behavioral finance. BF is your BFF. Okay. What does it mean? Okay. The central bank cuts interest rates. Is this good or is it bad? Well, it depends. So what do you expect could happen in a scenario like this? Well, it could lower the value of the currency. If you're an exporter, that's good. If you're an importer, that's bad. And if the behavioral part is, well, why did the central bank cut? Or why did they only cut by 25 basis points and not 50 basis points? So you have to ask these questions. Why did they do it? What is the intent? Now, if they're slashing and burning interest rates on their way to zero because the economy is dying, choking on its own blood, well, the fact that they're slashing might be bad. It's not that they're slashing, but the economy is dying. Now, what if the economy is doing okay and inflation is falling so that the central bank can normalize interest rates? And in that scenario, not only is the economy showing half decent signs of life, green shoots, if you will, that things are improving, but they have the ability to lower the interest rate because inflation is currently low, and therefore, in the shorter run, make the value of their products to foreigners more affordable. Or even if that doesn't happen, the fact that they're not dying, it's not the end of the world. It's not the end of the Australian economy. In fact, there's signs of improvement. that would allow them to cut. So there's a difference. Are they normalizing from high interest rates, which is good, or are they slashing and burning because the economy is dying? That's bad. Both are central banks cutting. Okay? So higher interest rates are restrictive. So if the economy is already slowing, you don't need high interest rates. So where would we get that kind of information? Oh, we already looked at it. Okay? Australia believes, okay, that inflation is on its way down to 2.0 and even lower. Do they need high interest rates? No. They could be at 2.8. Let's say if they wanted to keep interest rates 1% or 1.5%, we call that the neutral rate. You want to be somewhat restrictive, but not overly restrictive. So they could say, well, we could cut interest rates all the way down to 3, and we could be fine if we're below 2 on inflation. And then for some reason they expect this. Well, then this would be hikes, but probably not because things are bad, but probably because things are good. The economy is expanding again. So all we know is going out to the end of the year, okay, interest rates in Australia dropped to 4.0. How do I reset this? Here it is. I'm stuck. Why is this one only on the current quarter? How do I reset this one? Thought I saw a little button here. Where's the reset? Oh, there could be right there. No, won't let me reset. I noticed that. Now I'm doomed. Now I really messed it up. Anyway, so here you can combine interest rates. Switzerland and Japan are going to be the lowest. South Africa is going to be the highest. Okay? India is going to have the highest inflation. Anyways, too bad. I have to figure out how to reset this, where it is. Maybe I need to add it. Bummer. But again, I wanted to just show you how to think, how to use these tools appropriately, okay? You have the data. You don't need to guess. You don't need to be amateur anymore. You're the smart money in the room. I want you to know that. Why do you believe, Emerald, why do you believe Trump is being aggressive on tariffs? I would say the opposite. Okay. So, inflation in Canada came out as expected. Is there a trade on USD CAD? Not a scalp. No. Is there a scalp on Kiwi dollar? Maybe. Is there a scalp on pound dollar? Maybe. Is there a scalp on Aussie dollar? Sure. Maybe. Do you want to buy Aussie? Do you want to buy Kiwi? Well, maybe, right? So why don't we do some technicals? So Aussie, pound, or Kiwi long. No euro. Aussie, pound, Kiwi long, maybe. So let me show you how to do this. Settings. Okay, let's turn everything off except Aussie. Remember, there was no euro, but there was a pound, and there was Kiwi dollar. Those were our maybes. We're only looking for trend moves, and this is strength, but a threat. No trade. I'm done. Holy smokes! If you're going to trade this. Okay? If that's what you want to do, then that's how you do it. Gorgeous, right? Now, we thought maybe pound dollar long was potentially an opportunity. So based on implied volatility, this gets us down to here and here. So this little zippity-doo-dah. So if that's what you want to do, that's how you do it. We looked at Kiwi dollar as a maybe. And Kiwi dollar up. But see, I'm not a buyer of the Kiwi dollar. Wah, 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 wah. So I pass on that. Okay? In fact, I'm more inclined to sell it. So what this says to me is, first of all, you missed this opportunity. Now we've gone here where there's probably going to be profit taking, and that would be the next move. That's how I'd, right? But based on all the different Canadian CPIs coming out equal, in the past, that's not what's happened, but maybe that's not a big deal because it came out unexpected. So this has nothing to do with that CAD news. So if you're a bear, you sell the lower high, and this just gives you that. Okay. So, Richard, what tariffs? There haven't been any tariffs. So make sure you're trading reality and not what the new media says, news. Don't trade news, trade fundamentals. Okay, let's do some crypto. Let's do some stock indices. Let's do some commodities and we'll get out of here. Crypto. So we're only looking for trend. Okay, we're only looking for trending patterns. Strength with an opportunity. I'm going to say sideways. I'm going to say, yeah, buy a dip is what this says. So we had double bottom breakout pullback. Yeah, that might be Litecoin on a 15 might be an opportunity. This is weakness with a, I'd say it's a threat now, but setting up for an opportunity. So maybe Solana on a hourly. Ripple, okay, weakness. I think an opportunity to sell is setting up. It's not there now. This is based on 4 hours ago. So 4 hours ago, you can see it set up and it did go up. So now get ready. So that might be a maybe for later, but set it up now. Open up your chart if you're trading Ripple. But if you're long Ripple, this is bearish with a threat. Okay, bearish with an opportunity, bearish with a threat, non-directional, okay, and bearish with a threat. So not a lot going on in crypto right now. Let's do some commodities. Okay. Silver, bullish with an opportunity. Brent, range. Gold 30-minute chart, bullish with an opportunity. So you might look to buy dips on the 30-minute chart. You got that heads up 2 hours ago, so you're already slow as molasses. Flag breakout. If I was interested in trading this, I would be on a higher time frame. I need to see the prevailing trend. And in general, I think I'm a bear on oil. I explained this why in this morning's meeting at traders.com. But when I look at this 4-hour chart on WTI, I see weakness, lower low, lower high, lower low, lower high, lower low. This arrow says the next leg of the move is up. And if I'm a bear, I want to sell high probably around 71, 72. And then I'm going to bring it down. And that's that. Easy peasy. So I just went through dozens of charts. Took me a minute or two. Going to stock indices. Of course, I want the stock market to go up, and I'm worried about it going down. DAX, you got a strong market with an opportunity, came out 10 minutes ago. NASDAQ, strong market, opportunity came out 10 minutes ago. DAX on a 15-minute chart, showing strength with an opportunity that came out 25 minutes ago. DAX on the 30 came out 40 minutes ago. That's strength with an opportunity. NASDAQ on a 15-minute, take a break, son. Take a knee. FTSE 15-minute chart, that's strength with an opportunity. Dow, non-directional. ASX, go Australia, go! Showing strength with an opportunity, came out 18 hours ago, and it's been up. Okay, so look at that. Great. NASDAQ on the daily, it looks like we're range bound with a breakout. So in the next couple of days, you'd probably look for buying a dip. That's what this says. Remember, they're not predictions, they're patterns. So now you can get ready and drill down into that chart and see if you can confirm or deny it with technical analysis on smaller time frames. Nikkei, we have strength with a threat. Done. Done. Cool. Now, let me go here. Let me turn on all Forex except cross pairs. Why? Because I can. I can do whatever I want. I'm going to do that. Why? Because I can. Why? I'm the boss. So I'll filter everything. I'll even take out my exotics. Do I want USD yen? No, I'll pass on that. Anything else? USD Swiss franc, I'll pass on that. Euro Swissy, maybe. CAD Swissy, no. Aussie Swissy, maybe. All right, so there you go. So now we're going to look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 charts on 5 time frames. 14 charts on 5 time frames. 3, 2, 1. Pass. Weakness, opportunity, 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 weakness, threat, consolidation, bullish with a threat, bullish with a threat, bullish with an opportunity, pass, rising wedge, bullish with an opportunity, triangle pass, bearish, that's a threat, bearish, that's a threat, bearish, that's a threat, bearish, that's a threat. Bullish opportunity, pass, pass, done. 14 times 5 did it in less than, right? Was that 1 minute or 90 seconds? Okay, that was 70 charts in 70 seconds. I went through 70 Forex charts in 70 seconds. If you spend more time than that, then you're not competing. You're just not competitive. There are traders that are better. So now I could look at the ones I liked. So you write them down. And now you go to those charts only. Stop wasting your time. So now you just go to those maybe 5 or 6 charts. And now you do your analysis on those. Do you like it? Do you not like it? Is it going to continue? Is it going to reverse? Where are the pivot points? Where are the moving averages? Check out the multiple time frames. Can you thread together a trade plan? Yes or no? Out of the 5 or 6 you're focusing on, you might end up getting into trades on 2 or 3 of them. But they are fundamentally sound and they're technically precise. And everybody else is an amateur. It's $300 a month, bro. What's your time worth? Okay. Yeah. Amazing, right? Amazing. So get yourself some good fundamentals. Get yourself some good technicals. Get yourself some good market sentiment. Get yourself some good coaching. So on the performance coaching for today, I got to get rid of that. For today, we did a webinar at 3. We did a webinar at 7. We did a webinar at 8. I just did one now, which was another one at 8. Then we have one at 11. Then we have one at 4. That's just today. All right. Yeah, I think so. Good morning, everybody. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Cool, right? And hotel prices jumped 60%. We got the wheels off, and we run into it. Cool. 84. I'm not quite ready. Now inflation falls. See, some of the stuff we touched on today, but I do deep dives. I do deep dives, and we do multiple currency pairs. Silver got more. That's just one of the 5 hours of performance coaching for today. Redonkulous, huh? Yeah, redonkulous. So get on board. Stop trading like an amateur. It's pretty simple. Stop wasting your time. Stop burning your capital by making dumb, uninformed decisions. Okay? Let me on your team so we can trade together every day. Let me be your chief economist. Borrow my Harvard degree for $300 a month. Yeah, I'm hitting you hard because you need this. We all need this. I built it for us. So, I got to jump, babe. That was real. Enjoy the stock market open in about 12 minutes. Peace on earth. May the pips be with you. May your profits be above average. Have the greatest day ever. Be safe, be smart. May the pips be with you.